Welcome to Talk Tickers. We're diving deep into Repsol's first quarter 2025 earnings call today.
Yep, we'll break down the numbers and the strategy for you.
Our mission is to pull out those key insights, give you what you really need to know from their latest update.
Okay, so kicking off with the results snapshot. Adjusted income came in at 651 million euros.
Which was what, slightly up on the last quarter?
Just about, yeah. 1% up quarter over quarter. And cash flow from operations, if you exclude working capital moves, hit 1.6 billion euros. Pretty solid.
Solid cash flow. And CapEx.
Organic CapEx was 1.2 billion. Actually, the lowest number we've seen from them since the first quarter of 2023.
Okay, so holding back a bit on spending. But on the flip side, net debt went up.
It did, yeah. Climbed to 5.8 billion euros.
What drove that?
Well, a few things, really. You had the usual seasonal working capital build, money tied up day to day, then shareholder payouts, dividends, and buybacks, and of course, the cash out for the Bunge Iberia acquisition they completed.
Right, that makes sense. A combination of factors.
Sure.
Okay, let's break down the different business units. Upstream, exploration, and production. How did that look?
Upstream actually had a decent quarter. Adjusted income rose 3% compared to last year, landing at 558 million euros.
What was behind that?
Mostly stronger gas prices, and they managed costs well, too. That helped offset slightly lower production volumes.
Okay. And the industrial division, that's refining mainly, right? Sounds like a tougher story there.
It was, yeah. A significant drop in adjusted income for industrial, down to 131 million euros, largely because refining contributions were lower.
But you mentioned margins.
Right. There was some light there. Refining margins did show signs of picking up towards the end of the quarter, so maybe turning a corner.
A bit of a tale of two halves within the quarter, perhaps. How did the customer division do? Mobility, LPG, that sort of thing?
Customer division saw modest growth. Adjusted income up 3% to 160 million euros. Mobility and LPG were the main drivers there.
Okay. And low carbon generation, renewables.
That was a big improvement, actually. Adjusted income hit 5 million euros. Now, that sounds small, but it's a huge jump from last year.
What caused that jump?
Higher power prices really helped. Plus, they just had more renewable production online compared to Q1 last year.
Got it. Okay, let's pivot to the macro environment and their outlook.
Yeah.
Q1 was pretty volatile globally, wasn't it?
Absolutely. You had OPEC plus decisions, U.S. tariff talk, geopolitical tensions bubbling away. But interestingly, Repsol said the overall macro backdrop actually lined up pretty well with their initial assumptions for the year.
But things changed a bit in April.
They did acknowledge that, yes. April saw oil prices drop quite sharply, and the refining environment weakened again. So definitely some headwinds appearing after the quarter ended.
So given those April headwinds, did they change their full-year guidance?
No, they haven't. They're sticking to their full-year guidance under their original macro assumptions. And importantly, that includes their shareholder return plans, dividends, and buybacks.
They even talked about a stress scenario, didn't they? What did that involve?
Yeah, they modeled a tougher outlook. Assume Brent oil drops to $65 from April 1st, Henry Hub gas down to $3.50, and refining margins weakening significantly, like a $4 indicator margin.
And even under that scenario?
Even then, they project cash flow from operations would still land somewhere between 5.5 and 6 billion euros for the full year.
That sounds fairly resilient. Do they have levers to pull if things get that tough?
They do. They identified about €500 million, 500 million in CapEx flexibility.
Where would that come from?
Mostly from potentially delaying final investment decisions or FIDs on some renewable projects, and maybe slowing down the pace on some industrial transformation investments.
But key projects would still go ahead.
That's what they indicated, yes. And they stressed that even in that downside scenario, they could manage net debt and meet those shareholder distribution commitments.
Okay, good context.
Yeah.
Let's dig back into the upstream performance. Production was down slightly in Q1, you said?
Yeah, averaged 550,000 barrels of oil equivalent per day. That was 3% lower than Q4, mostly due to planned maintenance work they had in the UK North Sea.
Was that offset at all?
Partially, yeah, by higher output in Libya and the Marcellus Shale in the US. And they did say current production is already back up around 560,000 barrels a day now that maintenance is done.
And a big strategic move in the UK North Sea as well, the merger.
That's right. They've agreed to merge their UK assets with Neo Energy. The aim is to create a pretty major independent operator over there.
What kind of scale are we talking?
Projected production of around 130,000 barrels per day in 2025. And they're targeting over $1 billion in synergies, cost savings, efficiencies. Repsol keeps a 49% stake.
Seems like a significant move.
Yeah.
Are there new projects coming online soon in Upstream?
Yes, they highlighted 4 startups expected before year-end 2025.
Which ones?
Cipra in Trinidad and Tobago that actually just reached first gas. Then Leon Castile in the Gulf of Mexico planned for August. Lapa Southwest in Brazil around November. And the first phase of their PA project in Alaska before the end of the year.
So new barrels coming online. What about their hedging, particularly for gas?
They have a pretty active hedging program for their unconventional gas, extends out to 2027.
How much is hedged for this year?
For 2025, about 55% of the volume is hedged with a put-call collar structure centered around $3.61. Gives them downside protection, but some upside potential too.
And further out.
For 2026, nearly 60% hedged, mostly with a collar between $3.20 and $5.10, plus some calls higher up. And for 2027, about 15% hedged with a $3 to $5.75 collar. So locking in some price certainty.
Okay, turning back to industrial. Refining margins recovered somewhat, but faced some specific issues in Q1.
Exactly. Margins improved from Q4 lows, but they had planned maintenance shutdowns at Bilbao, Tarragona, and Portolano refineries. That obviously impacts throughput.
Anything else?
They also mentioned issues with higher water content in some Maya crude they processed, which apparently knocked about $1.10 per barrel off their margin premium.
Despite that, utilization rates seemed okay.
Yeah, pretty good, actually. 83% for distillation, 91% for conversion units. Shows the system was running hard when it wasn't down for maintenance. And they highlighted their flexibility to process different crude types as a key strength.
And positive news from their LNG plant.
Yes, the Colcas Pass LNG facility started commercial ops early, back in April. That means more LNG cargoes than planned this year, and they expect it to add about 100 million euros to operating profit in 2025.
Right. There was also that power outage in Spain, wasn't there?
Yeah.
How much did that affect them?
It did cause temporary shutdowns at 5 refineries, but they got power back overnight. No major incidents reported. The impact seems limited to maybe a few days of lost processing capacity. The market handled it with strategic reserve releases.
Okay, let's talk renewables and asset rotation. That seems to be a core part of their strategy.
Absolutely. They keep executing on that. They closed their 5th asset rotation deal in Spain, and importantly, their first one in the U.S.
Who was the buyer in the U.S.?
They sold a 46% stake in a 777 megawatt portfolio to Stonepeak.
And more rotations planned.
Yes. Another 700 megawatts in Spain, and they're targeting rotation for a 629 megawatt U.S. portfolio. They call it the Outpost portfolio by year-end.
Are those U.S. projects looking attractive for buyers?
They seem confident. Repsol noted that the fundamentals for these outposts projects things like the power purchase agreements and the capex costs are actually better than the portfolio they just sold to Stonepeak. They're aiming for double-digit equity IRRs on these sales.
And shareholder returns sounds like they remain committed despite any macro concerns.
Very much so. They started their first 2025 buyback program, 350 million euros, aiming to cancel those shares by the end of July.
Dividends.
Confirmed the second 2025 dividend of 0.5 euros per share. And they've already announced another 0.5 euros per share plan for January 2026.
And even in that stress scenario.
Even then, they committed to doing at least the minimum 700 million euro equivalent share buyback for the year. So returns seem pretty well underpinned.
Okay. What about Venezuela and the U.S. license situation? Any updates there?
They confirmed they received notification, like others, about a specific license potentially being revoked by late May 2025, but they made a key point.
Which was?
That 85% of their production in Venezuela is actually natural gas, not oil. And they said they have direct dialogue ongoing with U.S. authorities to try and maintain their operations there.
And potential U.S. tariffs on imports. How are they viewing that?
It creates uncertainty, particularly for new projects. So they're likely to be cautious about making big new investment commitments until there's more clarity. But existing projects with FID already secured, they don't accept a major impact there.
Got it. The UK joint venture, any accounting implications we should be aware of?
Closing is expected end of Q3. They don't see a relevant impact on the financials at closing itself. But they might reclassify the UK assets as held for sale in Q3.
What does that mean practically?
Mostly relates to accounting for UK liabilities, but again, they stress no significant impact expected on the overall group financials.
You mentioned the capex flexibility earlier. Can we break down that 500 million euros a bit more?
Sure. About $200 million could come from delaying FIDs on some renewable projects, another $150 million or so from just slowing down decisions on industrial transformation investments,
And the rest?
smaller potential delays in organic growth in their commercial businesses. But again, key upstream projects like Leon Castile and PA Alaska Phase 1 remain on track in that scenario.
Okay. And the efficiency program they started last year, is that delivering?
Seems like it. They expect it to contribute around 450 million euros in OPEC reductions this year, 2025.
Where are the savings coming from?
All over, really. UK operations, G&A costs in their US shale business, optimizing refinery maintenance using robotics, things like that. Also reducing the break-even for their chemicals business and general corporate streamlining. About a quarter of it comes from working capital optimization, too.
Seems quite broad. What about the outlook for selling more U.S. renewable stakes? Is the market still receptive?
Well, the fact they closed the Stone Peak deal in April during quite volatile market conditions suggests investor appetite is still there.
And the next portfolio, the Outposts one.
As we mentioned, they feel it has better fundamentals, stronger PPAs, optimized CapEx. So they sounded pretty positive about getting that rotation done, too.
Just a couple of finer points from the financials. Upstream depreciation was lower in Q1.
Yeah, D&A was down compared to Q4. Two main reasons. Lower production because of that UK maintenance, and also because they took some asset impairments back in Q4, which reduces the asset-based depreciation is calculated on.
And non-current provisions dropped significantly.
That's likely linked to the UK JV again, probably reclassifying UK liabilities as held for sale in anticipation of that deal closing in Q3.
And the Bunge Iberia acquisition they completed, what's the benefit there?
Main benefits are expected to be cheaper feedstock for their renewable fuels production. They estimated maybe $50 per ton cheaper, and access to new innovative feedstocks, basically enhancing their competitiveness in biofuels.
Okay. And lastly, tax rate and working capital expectations.
Effective tax rate for 2025 expected around 39–40%. Cash tax payments for the year estimated around 1 billion euros. And working capital. Assuming similar commodity prices, they expect it to end 2025 around the same level as end of 2024. The Q1 build was largely seasonal and linked to that refinery maintenance timing.
All right, a very comprehensive overview. Now for our favorite segment, the outrageous but plausible trade idea. Remember, everyone, this is absolutely not financial advice, just some food for thought based on the call. What have you got for us?
Okay, here's one angle. Repsol sounds really confident about maintaining dividends and buybacks, even in their defined stress scenario. Plus, there's obvious upside if the macro environment turns out better. So,
Hold on.
how about this? Consider a long position in Repsol stock to capture that potential resilience and upside. But to manage the risk if things do go south, maybe hedge it by buying some out-of-the-money put options expiring, say, in early 2026.
So capturing upside while capping downside.
Sort of, yeah. It allows you to participate if the stock does well, driven by that committed shareholder return and potential macro recovery, but gives you a level of protection if the stress scenario, or worse, plays out. It's playing their confidence, but with a safety net.
Interesting thought. Outrageous but plausible indeed. Okay, any other ideas swirling around?
Well, thinking about that UK North Sea merger with Neo Energy, that's creating a major new player focused on synergies, over $1 billion worth, they hope.
Right. Repsol keeps a big stake too.
Exactly. So a possible paired trade. Go long shares of companies in the supply chain that might benefit from the operational efficiencies of this bigger, leaner North Sea entity. Think service providers, equipment suppliers who might win more business.
And in the other side of the pair?
Sure, a basket of smaller, potentially less efficient North Sea operators. The idea being that this new, larger competitor could put more pressure on them. It's a bet on the synergies being realized and shaking up the regional competition.
A classic pair trade strategy applied to a specific M&A situation. Again, definitely outrageous, but plausible. And certainly not advice. Okay, let's wrap up.
So to summarize, Repsol navigated a pretty choppy first quarter, showed resilience through that integrated model.
Key takeaways. They're sticking to the full-year guidance, sticking to shareholder returns even under pressure. Progress on asset rotation continues, especially in renewables.
And that UK joint venture is a big one to watch, alongside the ongoing efficiency drive. These are probably the key catalysts going forward.
Definitely. This deep dive should give you a really solid framework for understanding where Repsol stands and where it might be headed. What are your thoughts on their ability to hit those asset rotation targets in this environment? Something to chew on. As always, do your own research.
Absolutely.
That was our deep dive into the Repsol Q1 2025 earnings call. Join us next time on Talk Tickers as we unpack another crucial investor briefing. Remember, this is for informational purposes only.
Not financial advice. See you next time.